gas analyst at Citi, Saurabh Handa, joins in to give us his outlook on the oil marketing sector, given the benchmark Singapore complex refining margins are on a downward trajectory. Saurabh, thanks for joining us. Can you tell us what your view is on the sector itself?
So on the OMCs, we actually continue to remain positive. Yes, they had a fantastic FY16 that probably took the market by surprise. But we think the market is still probably underappreciating the pricing power of these companies. Government intervention still remains not as bad as people have been fearing. These companies have been regularly passing on higher oil prices to the end consumer. The government has fully compensated them for under-recoveries on LPG and kerosene. Even though there are maybe some concerns on refining, on the marketing side of the business, things still look pretty okay. Valuations are very compelling. They trade at single-digit PE multiples with the dividend yields of 3 to 4% and strong ROEs of over 20%. So we still remain very positive on the outlook for the oil marketing companies, and we think they can continue to deliver a very strong performance.
All right, Saurabh, what is your pecking order on OMCs on the strong domestic fuel consumption growth?
So right now our pecking order is BPCL followed by HPCL and then IOC. We do have buys on all three stocks, but just to give a relative preference, that's our pecking order. The reason we like BPCL the most right now is A, it has the highest ROEs, so it has been more consistent in performance. B, we believe in a rising or in a moderately rising crude environment. BPCL is actually most hedged in terms of having a bit of upstream exposure. And that potentially can actually be a positive catalyst, something which the market is not focusing on right now, particularly on Mozambique, where we believe that there could potentially be a big oil major such as Exxon entering, which could be a big trigger for Mozambique valuations for BPCL.
Well, you know, IOC has underperformed other oil marketing companies. Do you think that will continue?
So you're right, yes, IOC has been a bit of a laggard compared to the other two. So we do have a buy on it. We believe there, yes, there could be a potential catch-up. Key will, I guess, be on how the Paradeep refinery scales up. Refining is a pretty significant contributor for IOC, and that's been a part of the business which has tended to be fairly volatile, especially because movements on the inventory front. Going forward, if Paradeep scales up on time and the refining margins start sort of normalizing, then IOC could potentially do well.
Okay, Saurabh, I wanted a view on the big heavyweight, Reliance Industries.
So Reliance is also a stock which we do like at these levels. There are potentially near-term headwinds because of soft refining margins and because of the uncertainty on their telco launch. But over the next 6 to 12 months, we see quite a few event catalysts for the stock which can take it higher. They have a lot of capital which was tied up in projects which will now start getting commissioned on their core refining and petrochemicals business, which should drive a turnaround in their core earnings trajectory. Also, there have been concerns on all the capital which has been sunk into the telco business, but that is now behind us, and we have the launch to look forward to. And the expectations on that front, in our view, have been extremely low, so the potential for positive surprise is there. So Reliance is definitely a stock which would be on our radar. There is potentially, as I said, a near-term softness in the stock, but we would use that as a buying opportunity from a 12-month view.
Okay, Saurabh, thank you for your thoughts. We'll take a break on that note, come back and focus on the commodity space.